POLESTAR PSNY has been a popular stock to trade for some time now, and in today's video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile for the moment, we should always be careful about which positions we pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Recently, POLESTAR finally completed its merger with GGPI and began trading under the new name PSNY. The typical reaction to such an event in the market is a slight increase in the stock price and maybe even an uptick in the volume as well, if the market were to operate with more optimism about the future. Now, with that being said, the price action of POLESTAR has been relatively disappointing in the recent trading session, and to be honest, I don't think that it really has anything to do with the title itself, but the external factors that have been plaguing the equity market for the last couple of months, which is the issue of inflation that ultimately forced central banks to increase their interest rates, which in turn caused bonds and other fixed income assets to be more attractive for institutional money. All these events ended up having an effect on the demand of the tech stocks. Nevertheless, the questions we should ask ourselves are whether the new models are going to be released this year, and if the market will meet the news favorably, and the extent of the reaction. I believe that the production may meet the same challenges the entire sector has been dealing with over the past few years, which is the supply chain management. The key components may not be able to make it in time, and that at some point, the stock will be under selling pressure for the same reason. I would price this factor in my trading approach, assuming that over the next couple of months, the stock may see additional turmoil due to uncertainty and supply chain issues. The second thing to look at is the state of the economy itself, and if the catalysts we think are going to be positive are actually going to be positive, or sufficiently positive. Because we have to remember that the market is not favoring the equities, and especially not the growth stocks. Is it going to be favorably looked at the release of the new models? With VIX numbers still at the decade high level and the oil price still at a very high level as well, I think that in the short and medium term it's going to be tricky, but definitely doable. The market usually reacts favorably to encouraging fundamentals, and most of those challenges should have been priced in. The only thing that may spook us is if the federal bond yields keep increasing, which seems unlikely at the current stage. Now, let's take a look at the technicals of the stock. The trading volume of POLESTAR has recently been 2.4 million shares versus an average volume of 3.8 million shares. Over the previous 52-week period, the price fluctuated between $8.64 and $11.36. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of a company, and we can use it to compare with the average volume, in which case it'll tell us if the company is enjoying additional momentum to reverse the trend or to break through current resistance. Even when the current volume is lower than the average, it is an interesting indication, because it may signify that a trend reversal could happen soon. The market cap of POLESTAR is currently around $3 billion versus an enterprise value of $1.1 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, meaning they're not things that you can see or touch, but the assets that will guarantee the company has a promising future, such as the brands, the intellectual properties, and schematics for new products. For startups, most of their valuations are usually based on those intangibles, and some of them were valued in very favorable market conditions. In concrete terms, what this means is that there can be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, but doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place, and that it has deflated back ever since. As we compare the current price to the historical price fluctuations, the stock is 1% higher than the 1-month low, 2% higher than the 3-month low, and about 10% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 125%. The put-call volume ratio is currently at 0.5. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 19,000 contracts a day versus the 30-day average of 25,000. In terms of open interest, the most recent volume of open interest has been 232,000 contracts compared to the 30-day average of 195,000. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right and selling the contract giving you the premiums, with an obligation to execute those rights should the counterparty choose to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio of put and call options are. If there's a lot of put options traded, there's a possibility for an uptrend. Or if there's a lot of call options, meaning a lot of people are expecting the stock to go up, the uptrend could have a reversal. The reasoning behind this is very simple. Most people react afterwards, it's way too late, and most options would expire worthless. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, as many great companies are also held by retail, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there is significant short interest in the total volume, that can be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 20% of the total float and 43% of the transactions coming out from the dark pools. Usually, if the short interest is above 15%, with a significant chunk of it coming out outside of the public exchanges, this may signify that there's an institutional position taken to short the stock, and that there would be potential for a short squeeze. In the case of Polestar, I would say that there's a lot of short interest to be sure, but it's a little bit too low, in my opinion, to be considered as a potential short squeeze target. My recommendation about Polestar is to start building a position by averaging down the next couple of months and to keep it for at least 24 months. I would recommend to commit between 3 to 5% of your portfolio's capital going forward. I would also recommend to split the allocation in batches of 20% at a time so that you can purchase more in case of further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.